business on the Bank Nifty.
Okay, all right, Anuj, thanks a lot for that. Well, given that banking and financial names are doing pretty well, let's get straight to our momentumizer. And the stock that I'm tracking is Indiabulls Housing Finance. It has, that capability of making big moves. But in Friday's trading session, well, it was a relative outperformer. So that's one reason why the stock did come on my radar. But I was looking at the traded volumes as well as the delivery volumes. Nothing really earth-shattering or nothing really to write home about with regard to the NSE data on Friday itself, if you compare it with the 10-day average. But the stock came out of the F&O ban. On a day-to-day basis, it was in the F&O ban. So maybe the stock deserves some kind of attention. And keep in mind, if you're looking at the 20, the 50, the 100, as well as the 200 DMA, the stock is trading above those levels. So, technically, it got some support zones lower. Let's see how the stock performs from here. And housing finance on the whole has been in focus. We could have a potential deal on Poonawalla in the next few days as well. So keep an eye out on Indiabulls Housing Finance.
Okay, so that's our momentumizer of the day. But there are plenty of stocks that will be in focus, continue to be in focus. For now, the pre-opening rates are kicking in about a minute from now. Couple of stocks that, of course, you need to watch out for. The aviation stocks could be in focus because the domestic air traffic data is back to pre-COVID highs. And we've seen it with the way, the Delhi airport is full. And that's, of course, gone viral on social media. But just keep an eye out on names like Interglobe Aviation, which have been doing well in any case. Apart from that, as we were telling you, stocks like Bharat Forge, etc., could also be doing well purely because of the focus on the defense sector. But HCL Tech, that stock took a sharp 7% knock in trade after the company told investors that growth will be near the lower end of its range. The management said that this downward revision is driven by higher than anticipated furloughs. To discuss this, we are joined by C. Vijayakumar, the MD and CEO of HCL Tech. Mr. Vijayakumar, good morning and thanks for joining in. That's the first question. Can you tell us what changed in the last 2 months that you had to give us a warning on growth after scaling up your guidance last quarter?
Based on our certain assumptions that we made in October about potential impact of macro, and usually in December, some clients ask for mandatory time off. So we had made some assumptions, and whatever the impact was a little higher than that. So that's why we had given a narrow guidance of 16 to 17% on services and 13.5 to 14.5 on an overall number. So in the narrow guidance, we said we will come at the lower end because the impact of some of the mandatory time offs and some of the macro aspects in some verticals were a little higher. And that's why we gave a little precise guidance. And especially that we've had an investor day, and whatever we know, it's very important for us to tell the street. However, we should keep in mind that 16% growth, even at 16% growth in services, it'll be one of the highest growths in the industry. So everything has to be kept with that context.
Okay, Mr. Vijayakumar, good morning. The three sectors which are seeing higher than expected mandatory time offs are BFSI, telecom, and high tech. But is it just one or two clients which are stressed out, or is it more broad-based than that?
I think it's maybe 3 or 4 clients in these verticals. That's what I would say. However, one should keep in mind, we did talk about the bookings. We expect to have a decent booking. The deal momentum is very robust, especially the vendor consolidation and the cost efficiency led deals. A lot of decisions are being taken and the deal flow is quite good. And we expect to have a decent booking this quarter. The pipeline is good. We expect to have a decent booking in the next quarter. Both of this will feed into the FY24 numbers. And what we also shared as an update was the talent situation is slightly easing. And we believe some of the efforts that we put in the last 2 years in terms of higher number of freshers hiring, also a lot more emphasis on upskilling, and also a lot more emphasis on nearshore locations. All of this will help us improve our margins in the near term. Currently, our guidance is 18 to 19% for this fiscal, but our aspiration is to get back to the 19 to 20% range as we move forward. So good deal momentum and good progress on all the cost levers that we have been working on. These were the 2 other updates that we gave, both of which are going to be very good for FY24.
All right, Mr. Vijayakumar, 3 to 4 clients in each of these 3 verticals. So can we assume that around 9 to around 12 clients are seeing some weakness?
May not be. I think it's just a handful of clients on all across the board, I would say.
Okay, so would you say that this could be an industry-wide phenomenon? I'm asking because we haven't heard from any other companies talking about large furloughs or, cancellation of orders. But what is your own view on this?
I can only comment on what we are seeing, but just looking at the environment, I think it's mostly common for the industry, I would say. Nothing very unique to us because we are working with these clients. There are other providers also working with same clients.
All right, Mr. Vijayakumar, do you think this slowdown, though, could spill over?
The counter to that is the strong deal flow that we are seeing. We have not seen any slowdown in decision making because the cost efficiency and vendor consolidation opportunities are getting decided as per plan. At least in US, we see that to be happening in a very, very fast manner. So I think that should help mitigate any further reduction in the discretionary spend, I would say.
All right, the FY23 margin guidance is at 18 to 19%, right? Will you be at the lower end, middle end or upper end? I ask because if you're scaling down your revenue guidance, then for sure there'll be some trickle-down impact into margins as well.
No, half the year is over. You know what the first half margin profile was. We will do better in the second half. I don't want to be more precise than that at this point.
Okay, then let's get your view on the price hikes.
See, we had a good benefit of realization in the last 6 months based on all the billing rate enhancement that we were driving. But moving forward, I think getting increases may be difficult, but I expect the pricing to be stable because still for some niche skills and some of the newer skills, the demand is quite high. So I think the pricing, I expect it to be more or less stable as we move forward.
Mr. Vijayakumar, the management of Mastek just told us that new acquisition of orders, perhaps there may be a slowdown. But what are you seeing in terms of deal pipeline and order booking?
I think order booking will remain robust, maybe a little less on the discretionary side, but more on the cost efficiency. And there's $120 billion of vendor consolidation opportunities that are in the anvil in the next 2.5 years. That's also one of the comments from ISG. So we are very strongly placed in vendor consolidation opportunities, primarily a model where the application and infrastructure services are being outsourced in an integrated manner with both the support and the change programs built in as a part of the new operating model. That's specifically a sweet spot where we have had a lot of wins. And I think this consolidation opportunities will drive a good momentum for us in the coming year.
Okay, well, we'll leave it at that. Mr. Vijayakumar, thanks a lot for joining in and explaining to us what's happening with the industry as well as, with the company. Prakash Diwan is still with us. Prakash, you heard from the management. Any thoughts? And if you're an investor in HCL Tech, should you just keep the faith?